So if you're a Canadian and not using your TFSA properly, whether or not you know this or you might not even be aware of this, you could be costing yourself hundreds of thousands of dollars. And no, this is not an exaggeration. This is quite literal numbers. I mean, I've been utilizing my TFSA since around 2009. I have multi six figures inside of my TFSAs, which puts me on track to hit the 7-figure mark in those accounts around my mid 50s. So if you can imagine having access, tax-free access to an account with 7 figures in it as you approach retirement, something that you can put money into every single year, pull money out of every single year, and pay absolutely no taxes, you can see why it is so important to utilize this account correctly. There are way too many videos on YouTube today that really oversimplify this account, and I am making this video to turn it into the all-in-one guide so that you can start using this account the right way and kind of avoiding a lot of the oversimplifications that are being placed on the TFSA today. It does not matter if you've been investing for 2 weeks or 2 decades, you will find a ton of value in this video, and you're going to want to watch the full thing to its entirety so you don't miss anything. And as always, if you are interested in some of the top holdings inside of my TFSA and how I look to build out my TFSA, you can head down below to the description. The report is absolutely free, just takes you a few seconds to get, and it can really save you a lot of time and maybe give you a new perspective on investing in the TFSA. But let's get right into the video. So first things first, what is the TFSA? This is a registered account, and a lot of people kind of separate their accounts from registered to non-registered. And typically what you will see with a registered account is this comes from the government, and these accounts usually have tax benefits. So other accounts I can think of right now would be the RRSP, the Registered Retirement Savings Plan, the RESP, the Registered Education Savings Plan, the LIRA, the Locked-In Retirement Account, things like this. These accounts are typically advantageous from a tax perspective, and the TFSA is one of the most powerful out of any of these accounts. Inside your TFSA, you can invest that money, and any earnings you have inside of the TFSA, you not only pay zero tax on the earnings inside of the account, but you pay zero tax on the money that you pull out. So this is a clear differentiator when it comes to the RRSP as well, because the RRSP, you will be taxed when you pull out the money, and you will also get a tax deduction when you deposit the money. So these accounts are very different, and I am going to get to this a little bit later on in the video, but there is situations where the RRSP will be more beneficial to investors than the TFSA, but I will talk about that a bit later so I don't get too much off track. So why is the TFSA so powerful and the preferred investing account for many people starting out? Well, first off, the TFSA is arguably the only registered account that has the same purpose and the same use case when you're 30 as it does when you're 90. So with an account like the TFSA, every single year you get your contribution room. It doesn't matter if you didn't file taxes. It doesn't matter if you don't have an income. It is not reported on your taxes. You get that contribution room every single year regardless. So something like the RRSP, is heavily dependent on your income, your salary. So the higher your salary, the more beneficial the RRSP is over the TFSA because of the larger tax deductions. However, when we get older, the RRSP becomes less useful. Our income will go down, especially in retirement, which effectively cancels out any sort of benefits from contributing to the RRSP. And then when we hit a particular age, 71, let's say, they force us to convert this to a RIF. When we look to something like an RESP, that only really extends as far as somebody's education will let them. So when you're not going to go to school, you either need to close this account down or you need to pull the money out. So the TFSA is the only registered account, I would argue, that has the same use case for the entirety of your life and is not dependent on your income. Now, again, later on in the video, I am going to explain particular situations where the RRSP might be a bit more powerful, but for the vast majority of Canadians, the TFSA is going to be the best account for you to get started investing and is going to be the one you want to prioritize in terms of contributions. So who can open a TFSA? Well, if you're a Canadian resident and you're over the age of 18, you can open a TFSA. Now, there are some specific provinces like British Columbia, New Brunswick, Newfoundland, where you cannot open a TFSA until you're 19. This is because in that province, you are not allowed to sign a contract until you are 19 years old. So what the government has done is here, you're not allowed to open a TFSA until you are 19 years old, but your contribution room will accumulate from the age of 18. So quick example, somebody from Alberta can open a TFSA when they turn 18, and let's say they're going to get $7,000 in room that year. I'm kind of making up this contribution room just for the sake of example. If you're in BC, you are not allowed to open that account until you are 19, but when you open it when you are 19, you will have the $7,000 from the year you turned 18 and the $7,000 from the year you turned 19. This is to kind of take away the advantage somebody from, let's say, Alberta would have over somebody who couldn't open this TFSA until they were 19 in British Columbia. As I had mentioned, unlike the RRSP, you do not need an income. You do not need to file your taxes to get a TFSA and to earn your contribution room. It is attached to your social insurance number and will automatically be added every single year. So how many TFSAs can you own? And this is a question a lot of people get, and a lot of people kind of don't understand, I guess I would say. You are allowed to open as many TFSAs as you want. I believe I have 10. I've, swapped brokerages so many times from different investment brokerages, different banks over the years, over my 16 plus years of doing this. I've managed to, have about 10 TFSAs. Now, a lot of people kind of think they have to go around and close those old accounts, or, they're kind of worried that they're on their MyCRA account and they're seeing all these TFSAs and think they might be doing something wrong. The only thing that matters is the contributions to these accounts. I could take my $7,000 in TFSA room and I could put $700 in each of those 10 accounts, and I would be completely able to do this. What I couldn't do is take those 10 TFSAs and put $1,000 into each one of them. That would cause me to have an overage. So no matter how many TFSAs you have, just keep track of how much money you are putting in each, and you should be completely fine. Now, if it makes it easier on you, if it makes it easier for you organizationally to close down existing TFSAs that you don't use anymore, by all means, go for it. There is no penalty, I guess you could say, to closing down a TFSA. So let's get into contribution rooms. So the CRA started the TFSA in 2009, and they gave it a contribution limit of $5,000 a year. And what you'll notice by the chart here is every single, I would guess we'll say 4 or 5 years, we get about a $500 bump in terms of total contribution room. And the reasoning for this is contribution room is inflation linked. So the amount of money you are allowed to put in your TFSA is directly linked to CPI and the overall inflation rate here in Canada. If we have 2% inflation every single year, we can make the relatively basic math that we're going to get a 10% bump to the TFSA contribution room every 5 years. Now, obviously, it would be a little bit more than this because that 2% compounds over top of each other, but this very generic math should get you, at least an idea as to how often the contribution room has gone up. So you will notice something in this chart, and that is between 2023 and 2025, contribution room jumped from $6,000 to $7,000. So this is a 17% increase in total TFSA room over the course of a few years, which is much different than we're used to seeing. And this is because of the higher inflation we realized over those years. So what you do need to know is that this number is inflation linked. Whenever you see an increase in the overall TFSA contribution room, it is because inflation has gone up to the point where the government has felt the need to adjust this number. Now, they will always round to the nearest $500. So as soon as that number gets closer to the next $500 interval, they will raise it by $500. Now, I'm not going to go over total contribution room because you could be watching this video in 2026. You could be watching this video in 2029. However, it is very easy to check on the annual contribution room for your TFSA. You're going to be able to see this on practically any government website. They're going to give you the total amount of contribution contribution room you should have depending on when you open this account, and the contribution room for that current year. Now, the contribution room formula is relatively easy to calculate. Your current room is your unused room from previous years plus the current year's limit plus any withdrawals from the previous year. So if we do a quick example, let's say you had $10,000 in unused room. This year's limit is $7,000 and you withdrew $500 from last year. So we have that $10,000 in unused room. We add the $7,000 in new room and we add the $500 you withdrew last year. This means your new contribution room for the upcoming year would be $17,500. And one huge warning for your contribution room: make sure you are tracking this yourself. Do not rely on the CRA website when it comes to TFSA contribution room. I actually did this many years ago. I relied on this website and forgot that I had contributed earlier, and I ended up with a TFSA overage. I kind of eliminated this relatively quickly. I withdrew the money quickly, but the fact of the matter is, some people might look at that amount, they might contribute, and they might not notice for a period of 6 or 7 months and end up paying a bunch of penalties. This number on the CRA website is it's just not updated all that accurately, especially if you're doing something like weekly contributions to a TFSA, if you aren't necessarily able to maybe lump sum that amount into the account. So please keep track of your own TFSA contributions. It's really not that difficult to do so, and it can save you a lot of headache down the line. Now, the final thing I'll speak on when it comes to contributions is, let's say you're fortunate enough to have your TFSA maxed. And I do believe a lot of people overlook something like this, and it's actually something I am doing right now, and that is contributing to my spouse's TFSA. You can gift your spouse money in order to contribute to their TFSA. The CRA does not penalize this, and the CRA also, if you gift them the money, it is their returns to earn inside of that TFSA, not yours. So this is a great way to, let's say you are in more of an advantageous position income-wise, you've maxed out your TFSA, your spouse has an empty or kind of underutilized TFSA, you can easily just gift them the money, they can invest inside that TFSA, and if your spouse does not want to manage that TFSA, you could easily do this. So this is kind of a little hack, I guess you could say, to maybe get a bit more tax-free compounding in terms of your overall investment income. So the final thing I'll talk about in terms of contribution room, and this is a bit of a unique way to invest in your TFSA, but depositing US dollars in your TFSA. This is something I do almost every single year because I do have quite a large portfolio of US stocks. It actually makes up the majority of my portfolio overall. I will take US dollars at the start of the year and deposit it inside my TFSA. Now, there are a few intricacies you need to know with something like this. And the first one is, no matter when you bought that US dollars, no matter what you converted the currency at, the contributions in terms of actual dollars that are going into your TFSA, that is based on the exchange rate the day you put it in your TFSA, not the day you actually exchanged it. So let's say, for example, the money that I converted to US dollars back in 2021 at 80 cents, I had in a savings account right now and I contributed to my TFSA today. That 80 cents that I converted it at back then is completely irrelevant. What will matter is what the Canadian US dollar exchange is right now, and then I can take that US dollars, figure out how much it is in Canadian dollars, and kind of work that out to only contribute the certain amount I can into my TFSA that does not cause me to go over. Now, why would you do this? Well, you would primarily do this to avoid heavy exchange fees at particular brokerages. If you have some place that allows you to do Norbert's Gambit, just contribute in Canadian dollars, convert it when you're in there. But if you're with a platform like, say, Simple Trade that charges you 1.5%, if you can get US dollars cheaper elsewhere, it might make sense to contribute US dollars directly to your TFSA. But this is pretty much it for the contribution room and the contributions element. Let's move on to withdrawals. Withdrawals can be a little bit confusing for many. As I had mentioned previously, the contribution room for the TFSA includes the addition of previous year's withdrawal. So if you withdraw money in this calendar year, you can recontribute it the next year. However, don't confuse next year with a year later. So let's take a quick example of somebody who withdraws $5,000 in January. Let's just say January 20th. A lot of people are under the assumption that they will not be able to contribute that $5,000 until the next year, January 20th. So we're talking about 1 year total, when in reality, somebody who withdrew $5,000 this year in January can recontribute that money on January 1st of next year. And in addition to this, if we have somebody who withdrew money on December 28th of this year, they do not need to wait until next December to recontribute that money. In fact, they really only have to wait just a few days. They just have to get to January 1st before they can recontribute that money, before that money will be factoring in to their contribution room. And of course, if you have existing contribution room, let's say you withdrew $5,000, but you have $20,000 in room, you don't have to worry about that $5,000. You could realistically recontribute that $5,000 and it would be perfectly fine because you have the existing room. So moving brokerages, and this is probably one of the biggest and most detrimental issues I have seen with people who are kind of messing this process up, causing a forced withdrawal and causing a lot of penalties. So if you are switching brokerages, never withdraw the money from your TFSA and recontribute it to the new brokerage. Now, this might not get you in trouble if you have pre-existing TFSA room. Let's say you're moving a $20,000 TFSA and you have $60,000 in room. This won't get you in trouble, but it is still a very, very good practice to simply transfer from brokerage to brokerage. Initiate a transfer from one brokerage to the next and let them handle the movement of your account. What I see so many people do is they say, okay, I want to move from Questrade to Wealthsimple. I'm going to withdraw my TFSA money at Questrade and I'm going to initiate a deposit into my TFSA at Wealthsimple. That will be counted as a withdrawal and a deposit. And if your TFSA is maxed and you do this with a large amount, you can imagine how detrimental the penalties could be. Let's say I take a $100,000 TFSA, I withdraw that from Questrade and I deposit that into Wealthsimple. You could easily get hit with a $100,000 overage on your TFSA and you are charged 1% a month. Now, yes, you could probably get your way out of this dealing with the CRA, kind of explaining the situation, but you never even want to get involved in this situation. So just make sure in this case you are transferring, not withdrawing and depositing when you are moving brokerages. So that's pretty much it for withdrawals. There's really not much in terms of withdrawals with the TFSA because this account is so flexible. Let's move on to what you can actually do inside of this account. And for the most part, you can hold virtually anything inside of this account. We can hold GICs, we can hold high interest savings ETFs for maybe more short-term goals. We can hold mutual funds or ETFs for passive investors, somebody who just wants to buy the index and kind of get on with their life, or, if you're looking to dabble in individual stocks for potentially, outsized longer term growth, you can buy individual stocks globally, pretty much. And they have even made options in some cases allowed in these accounts. For example, you can sell covered calls inside of a TFSA. I'm not going to dive too much into that, but they've added the element of options inside of these registered accounts for anybody who wants to explore those. Now, one thing you are not allowed to do is utilize leverage. They will not allow you to borrow money in your TFSA, but what a lot of brokerages are doing now is allowing you to use margin elsewhere and leverage your TFSA's assets. So for example, if you have $100,000 in your TFSA, these brokerages will allow you to utilize $100,000 in margin in your taxable account. And then from there, they will utilize those TFSA assets in order to kind of guarantee that margin is able to get paid back. So these are the ways that brokerages have kind of worked around this. I mean, if you're a beginner, I would not touch this at all. I would not dabble in margin. You can really blow up an account relatively quickly when it comes to margin, but just know that if you are interested in potentially, leveraging your TFSA's assets, you can do this in some situations through other brokerage accounts. So in terms of investing inside of the TFSA, I do just want to put one thing to bed, and one of the worst pieces of advice I have ever heard said about the TFSA, and that is the fact that you do not want to hold U.S. dividend paying stocks inside of a TFSA. And why is this the case? Well, there's a tax treaty between Canada and the US where retirement accounts, the US will not charge the dividend withholding tax on US corporations, their dividends paid to Canadian investors. Now, the difficulty here is the TFSA is not regarded as a retirement account. The RRSP would be one, for example. So if you hold US dividend stocks in an RRSP, you won't be charged a withholding tax. But in a TFSA, if you hold a company, a US company, and they pay you a $1 dividend, you will only get 85 cents. They will take a 15-cent withholding tax on that $1 dividend. And the difficulty with the TFSA is you are not allowed to claim that via a foreign tax credit, whereas in a taxable account, you would be able to. So you see a lot of people advising investors to not hold U.S. stocks in their TFSA, not hold U.S. dividend payers, U.S. ETFs that might pay dividends inside of a TFSA. And on the surface, I think this is just terrible advice, and I'm going to explain why. If you are in the position where your TFSA is maxed, you have an RRSP, you have a taxable account, you are generally in a position where you can kind of allocate your assets specifically to certain areas, certain accounts. So let's take in my instance, my RRSP is maxed, my TFSA is maxed, and I have a taxable account. I am in the position where I cannot hold US stocks inside of my TFSA because I can put them in my RRSP and kind of save that 15%. However, where this information causes people to go down the very wrong path, in my opinion, is if they're just starting out, the TFSA is their first investing vehicle, it's their entire portfolio, and they're contributing annually to it. Let's say they're maxing it out every year, and they've heard the saying, don't hold US dividend stocks in your RRSP, don't hold US ETFs that pay a dividend inside your TFSA. What they'll end up doing is they will just not hold US stocks. The TFSA is their entire portfolio. They don't want to hold US stocks because they've been told not to, because they're going to lose 15% of a dividend. So they end up holding 100% exclusive Canadian stocks. And what ends up happening is, because this is their entire portfolio, they're 100% Canadian equity allocated. They have no exposure to the US market over the silliest amount of taxes on a dividend paid. I mean, even when we consider US ETFs, realistically, there could be a lot of capital gains inside that distribution from the ETF. The dividend portion, which you will be taxed on, could be so minuscule that you're avoiding exposure to a much faster growing economy for the sake of saving a 15% withholding tax. If you are in a position where you can actually allocate specific areas of your portfolio to accounts to mitigate these taxes, by all means go for it. But if the TFSA is your only account and you've been told by somebody that you should not own US dividend paying stocks in this account, that's just silly. You need to be well diversified. You need to not hyper concentrate your portfolio in Canadian stocks just because you want to avoid a very minuscule tax on a dividend. So the TFSA versus the RRSP, and I could probably do a full video on this. I mean, if you want me to, head down below to the comments and let me know. So a lot of people make the assumption that the TFSA is automatically better than the RRSP. And this is because when you withdraw from the RRSP, you are charged tax. So if you withdraw, say, $100,000 from your RRSP when you're in retirement and your tax rate is 15%, you will be taxed $15,000 on that $100,000 withdrawal. Whereas with the TFSA, you would be taxed nothing. So people automatically make the assumption that the TFSA is better, but the actual benefits come at the front end of these accounts. So with the TFSA, when you make the deposit, you are not given any sort of tax credit on that deposit, whereas with the RRSP, you are. So generally, if you are a higher income earner, you will benefit more from utilizing the RRSP over the TFSA. I did this earlier on in my career when I was making more money in a much higher tax bracket. I was utilizing the RRSP and leaving my TFSA behind up until the point where I maxed out those RRSPs. And let's go over a simple example to explain this. Let's assume you contribute $10,000 to your RRSP while you're in a 30% tax bracket. Come tax time, you will get $3,000 back in terms of a tax refund. Obviously, all else equal, you could owe somewhere else, but regardless, that $10,000 contribution will get you $3,000 back. Now, let's say in retirement, you withdraw that money and you're in a 15% bracket. You will only pay $1,500 in taxes on that $10,000 withdrawal. So you can see the gap there. There has been a benefit from you contributing at a 30% tax rate and withdrawing at a 15% tax rate. So if you are in this situation, and obviously there's another slew of information that I would actually need to know to definitively say the RRSP is better for you. That includes pensions, it includes other incomes, all that type of stuff. But this surface level example with obviously made up tax rates as well, this can give you an idea as to whether or not the RRSP might be more beneficial to you than the TFSA. It was for me earlier on, and I utilized it heavily and got a lot of money back in terms of initial tax credits, and ultimately will pull that money out at a much lower tax rate when I retire. But once my income got lower, I went more to a self-employed business model with Stocktrades. The TFSA was the higher priority for me, and I ended up maxing that one out. So now that we've gone over the core fundamentals of this account, let's get into relatively common slip-ups I see all the time when it comes to the TFSA, and the first one would definitely be over contributing to this account. So if you over contribute, you will pay a 1% monthly penalty on the over contribution to the account. So let's say, for example, you double deposited at the start of the year. Instead of $7,000, you put $14,000 in, and you just didn't pay attention to it, didn't pay attention to the notices, the warnings for the better part of a year. So you would pay $840 in penalties on that $7,000 contribution. Now, what a lot of people think is that the penalties are compounding. So once you get charged the penalties, those start accruing interest. No, it is just the overage that you are charged penalties on. And another thing I've actually heard from some people is that they really don't mind the overcontribution because they think they can kind of outrace this 1% penalty. So they'll try to earn more than that from the overage instead of withdrawing it. And this doesn't work either, because you will be taxed on the overage. It does not matter that that money was earned inside of a TFSA. It was earned with overage money, so you will be taxed on it. It is almost impossible to outrace this penalty. I mean, we're getting up there with not necessarily credit card interest, but, middle of the line between a line of credit and a credit card rate. You're not going to outchase this. So the quickest solution to this is really not that big of a deal. I've done it myself. The quickest solution, get a hold of the CRA, let them know you overcontributed, and pull the money out. It really does not take long. It's not as big of an issue as overcontributing to an RSP, which generally requires a bit more paperwork. Just withdraw the money and, be done with it. So the other slip up, and this is the most common and the most detrimental I have seen out of all the errors that I see people make with the TFSA, and that is speculating too much. Your TFSA contribution room, you need to be treating it like it is your baby, because realistically it is. If you blow that money, if you lose that money, it never comes back. That contribution room never comes back. If you buy a bunch of speculative stocks inside your TFSA, lose all of it, and you just hope to kind of make up for it next year, it doesn't work that way. In a taxable account, sure, you can take $10,000, blow it on a speculative mining stock, and the next year, you could add $10,000 back. No harm, no foul. With a TFSA, if you have $7,000 in room and you blow that $7,000 this year, next year, all you're getting is your new contribution room. You aren't getting that $7,000 back. And I actually have personally known somebody who has done this, and they blew over $30,000 on a speculative stock inside of their TFSA. And I'm going to show you a quick example of how this is going to end up costing them $350,000. So let's say we have two investors each. They have $100,000 in their TFSA. One invests responsibly. They just buy an index fund. They're earning 8%. But the other one is my friend who lost $30,000 on penny stocks inside of their TFSA. So at the end of 1 year, one has $100,000, the other has 70. So if we make the assumption that the penny stock investor learned their lesson and now they're going to buy that 8%, index fund, and they're going to earn that 8% on average for the next 30 years. The first investor who invested responsibly the whole time will have $1.86 million in their TFSA, whereas the person who kind of blew that $30,000 will have around $1.5 million. So you're talking about a $350,000 difference in terms of how much money these two have in retirement. And keep in mind, these investment calculators are under the assumption that the TFSA contribution room stays the same. In fact, it's probably going to go up. So that person who had $100,000 in and now has 1.8 million, I'd be willing to bet that'd be closer to 2, considering that contribution room should continue to steadily escalate over the next 30 years. I mean, treat your TFSA as a long-term compounding vehicle, not a casino. There's way too many people who speculate too heavy in this account. In my overall investing portfolio, my RRSP, my Lira, my taxable account, my TFSA, the TFSA is the most conservative portfolio basket of stocks I have out of any of my portfolio. And this is because I do not want to blow this contribution room. It's just not worth it. This account is way too valuable to be messing around with it because it could cost you, in this case, $350,000 by the time you retire. Now, the other one is Successor versus Beneficiary. Now, this is a huge thing that Canadians often overlook. So if you are married or have a common law partner, you can name them as the successor of your TFSA. So if you were to pass away, it kind of assumes that the TFSA was theirs the entire time. There's really no tax implications in this regard. You pass away, your TFSA gets moved to them, and there's really no indication it was ever yours. You know what I mean? Like, obviously there is, but what I'm saying is there's really, it's the smoothest process you can imagine. Obviously, they don't get any extra contribution room. You stop accumulating that when you pass away, but effectively, they have the same investments, they have the same tax-free status as when you were alive. Nothing changes. Now, if you name somebody else a beneficiary or you forget to name a successor, this is a big, big difference. So in this case, the TFSA stops being a TFSA when you pass away. Now, the beneficiary gets your TFSA tax-free, yes, but if there's any growth inside of that account over the process of actually getting it transferred to them, they will end up having to pay tax. So let's say, for a quick example, you have $100,000 in your TFSA, you pass away in January, and the market goes on a big tear. It goes up 20% by the time your beneficiary gets the TFSA in July, let's say. They will get that $100,000 tax-free, but that 20% the market has gone up, that 20% gap, the $20,000 in income, they will be forced to pay taxes on that income. So obviously the successor can only be your common law or spouse. If you do not have a common law or spouse, you'll have to name a beneficiary, but it is better to name a successor if you can. And if you do forget about this, you can end up, kind of causing some frustration for a common law or a partner that you haven't named as a successor that could potentially just be a beneficiary and have to pay a bunch of tax that they really shouldn't have had to. Now, the final slip up I'm going to go over, and is one, a lot of people talk about it, but not a lot of people have heard about it, myself included, but that would be day trading inside of the TFSA. Now, I've been doing this for 16 plus years. I've been doing stock trades for nearly a decade. I've interacted with tens of thousands of investors, I could argue, over podcasting, website content, premium members, things like that. I have only ever heard of one person getting caught doing this. So if you make too many trades inside of your TFSA, there is the potential for the CRA to deem this as a business income. They might think you're operating your TFSA like a business, and as a result, they will tax you on all of the gains you earn inside of this. And the one main detriment here is day traders tend to have a lot of losses, and in a taxable account, they can offset those losses. With the TFSA, they will tax you on your income, but they will not allow you to claim any losses. So in theory, where this can get very ugly is, let's say you take your TFSA, there's $100,000 in it, and you double it. You double it to $200,000. You have $100,000 in taxable income if you get caught as a day trader. But let's say you blow that $200,000 the next 6 months. You get a bit too greedy, you blow your entire TFSA. They will not let you offset those gains with that loss. You'll be stuck with that $100,000 taxable bill, and you blew $200,000, but there's no forgiveness in that regard. So another thing, I'm not trying to kind of set a gauge as to where you'll get caught, but I have known plenty of people who have made 80, 90, 100 trades a year inside their TFSA, and they have never got caught. Now, the person who got caught, on the other hand, the one that I knew, he made around 400 trades a year inside of his TFSA. Way too much. And again, I'm not trying to set a benchmark as to what you can do, and the government does not set a benchmark either. They make it very opaque, and I think this is intentional, because if they came out and said, oh, if you make over 100 trades a year, we're going to tax you as income, people would make it their mission to make 99 trades a year. They make this very vague, very opaque, so that nobody really knows where the line is, and nobody really kind of puts a pressure on to cross it. Instead, you should be treating this TFSA as a long-term investing in vehicle. You should not be trading inside this thing. You just should not. The contribution room is way too valuable. You don't want to be doing this. And if you do get caught, and again, I've only ever known one person to get caught, it is ugly. It is not good. So everybody, that's pretty much it for the video. This is probably a long one, but I wanted to make the most comprehensive guide on the tax-free savings account that you can access today. I hope I did so. I hope I covered a ton of information and kind of, stomped out some possible cliches that a lot of people say the TFSA is bad for. A lot of people say the TFSA is good for, when in reality, they aren't necessarily untrue, but depending on your individual situation, they can be very different. So if you like this video, head down below, like the video, subscribe to the channel, comment, let me know, because I will make more content like this. I have no problem making more content like this as long as people like it. And as always, if you want a ton of equity research for potential stocks in your TFSA, check out my YouTube channel. There is a ton of content on some of the top opportunities in the country. And if you want that free guide on what I am holding inside my TFSA, head down below in the description. You can sign up for that. It takes just a few seconds, and it is a very valuable piece of content. And as always, everybody, stay tuned for more great investing content.